Welcome guys. Today we'll be talking about inflation. Now there's a lot of information coming out about rising inflation in 2021, and sometimes it's hard to wrap your head around what's actually going on. But in this video, I want to cover the truth about it all. We'll cover the important questions like how do you prepare your investment portfolio for inflation, and when you can expect to see the impact of inflation on your portfolio. Your time is valuable, so let's dive right in. To establish a baseline, we'll first want to define inflation. Then we'll look at why everyone is so concerned about it, particularly in 2021. Then we'll dive into the potential effects of rising inflation and the timeline. Finally, and most importantly, we will discuss the 3 best investments to protect your portfolio against inflation, and be sure to stick around until the end for a bonus investment. As always, if you find something valuable along the way, drop a like. That is always appreciated. So let's begin by defining inflation. Now, inflation does have a lot of complicated effects, but the actual concept itself is pretty simple. Inflation is the decline of purchasing power of a currency over time. A great example of this is when your grandparents explain that they used to be able to buy a slice of pizza for a nickel. Now you can't name a product you can get for a nickel in today's economy. The Federal Reserve, which is essentially the central bank for the United States, typically targets a 2% inflation rate for goods each year. They do this because they believe slow and steady price increases help to keep businesses profitable, which helps them sustain growth, which then helps the economy grow as a whole. You would never really notice the price increase from year to year on most things you buy, like groceries. But now, both people and businesses are starting to notice price hikes in 2021. Now, there can be a lot of reasons why we see rising inflation, but one thing over the last year sticks out like a sore thumb, and that is those stimmies and the government printing more money than has ever been seen before in our history. To put this into perspective, let's take a look at a chart tracking the supply of the US dollar over time. And so here you can see this blue line represents the money supply over the last 45 years. We can see that slow and steady growth we expected right up until the 2008 financial crisis. Then it starts increasing slightly faster after bailouts, stimulus, and low interest rates pump more money into the economy. Then we see the COVID pandemic in 2020, which launches the money supply to the moon. Many experts are saying that from the beginning of 2020 to mid-December, 35% of all US dollars in existence were printed within that time frame. One of the issues is that there is no end in sight at the moment, and that number has risen above 40% since the end of 2020. Another way to see just how correlated this is with COVID relief is by tracking the US dollar index, which you can find by looking up the ticker DXY. As you can see, the value of the dollar was pretty stable coming into 2020 and even stayed that way up until April of 2020. But almost to the day when the first round of stimulus checks went out, we can see the value sent on a downward trajectory with no sign of a rebound at all, falling all the way down below $90 where we are today. Now, the dollar index, while a good indicator of inflation, doesn't actually measure inflation. For this, we will need something called the Consumer Price Index, or CPI. This can actually be found right on the government's website, so I went there and checked it out. So this graph is showing the percentage increase in prices from May 2020 to May 2021, being broken down into different categories. First, we can see the rate across all goods was 5%. This accounts for everything you might buy on average, and you are paying 5% more for the same items you bought last year right now. Then it shows food specifically at 2.2%, and this huge bar here is energy, which is just at an insane 28% number. The last bar here typically represents what is left out of other major categories, and we see that hovering around 4%. So now that we've wrapped our heads around what is causing inflation in 2021, let's talk about the real-world consequences we might see. It has become increasingly apparent that companies are going to start raising prices because of the rising costs to produce their products. Typically, they pass that extra cost they have onto you as a consumer. So household names like Procter & Gamble and Coca-Cola have already announced price increases coming this year. The scary part about this is that they are somewhat late to the party. Many other companies got ahead by increasing prices steadily over the course of the last year. Here you can see from April 2020 to April 2021, companies operating in the grocery, household care, and baby care industries have been raising prices over the last year. even more aggressively than the 4.2% average we saw in the CPI. This is all to say that at least in 2021, you should be expecting to pay a premium for whatever you buy, and the chances are you've already seen this happening, especially at the gas pump. If we continue down this path, the other major consequence would be an interest rate hike. Many experts are expecting this to come sometime in 2022, but the basic effect would mean higher prices as well. Mortgage rates, auto loan rates, and general loan rates would jump overnight. This would make it harder for both consumers and businesses to borrow money, which means ultimately slowed economic growth. And in some cases, interest rate hikes have been known to trigger economic recessions. To make sure we are hedging against inflation in our investment portfolio, we want to look for price inelastic goods or services. This essentially means that the demand for the goods stays relatively unchanged when the price increases. In other words, we need to find products or services that are necessities and have no substitutes. The first investment that comes to mind as a hedge against inflation is obviously gold. Now, gold is always mentioned because its price isn't tied to the dollar, and gold is gold. In other words, there is no substitute for those who want to buy the real thing. As many say, gold is God's money and it can't be faked. And to be clear, a gold ETF would not be the same hedge as physical gold bars. Within an ETF, you would be subject to the fund manager's decisions, and you wouldn't necessarily own the actual gold, you would own a shared interest in the gold that the fund has accumulated over time. Physical bars, not gold stocks, make for a solid hedge against inflation in most cases. It also tends to be the least risky since there is an open market for gold and you could always sell your gold bars whenever you would like. But the biggest issue with gold is that it isn't as consistent as we would hope. There are a few instances throughout history where inflation was rising and the price of gold actually fell. While this isn't typical, it is very important to note before investing in the precious metal. The second inflation hedging investment is healthcare stocks and ETFs. A recent study out of Dartmouth found that the healthcare industry was most correlated with inflation and the most immune to inflationary pressures. Healthcare products and services fit our price inelastic model very well. For example, for diabetes patients, insulin is insulin. There is no replacement for that. If prices rise, someone with diabetes would cut spending from every other area of their lives before stopping buying insulin. Now, I wouldn't necessarily buy individual healthcare stocks, but a bet on the industry as a whole with an ETF or index fund would be a safer play if you're just looking to protect your money against inflation. A few examples of popular healthcare ETFs include XLV and VHT from Vanguard, but I would suggest doing your own research of the top 50 healthcare ETFs, which I have linked in the description below. Last but not least, our final inflation hedging investment is real estate. Now, there are real estate investment trusts or REITs, and there is physical real estate property. A REIT can be bought on the stock market and represents a company that owns income-producing properties. As those properties earn more, so do you. But physical real estate, you yourself would have to manage or have a property management company manage for you. But you have full control of the location and the type of property you invest in. To understand what the better investment would be during inflation, we need to understand how real estate tends to benefit from it. The first reason is that as inflation rises, property values tend to rise, which gives value to the investor in terms of appreciation. The second reason is that in an inflationary period, rents tend to increase, putting more money in the pocket of the investor each month. However, an important thing to note is that not all places will be able to support these increases in home prices and rent. Meaning, when you are looking for a REIT or a physical property, you need to be looking at places that have high average annual income, a low unemployment rate, and high job growth. Many professional real estate investors I know are turning to places like Salt Lake City, Utah, Raleigh, North Carolina, and Nashville, Tennessee. For this reason, I would say physical real estate may be a better hedge unless you know the exact properties the REITs are invested in. Finally, for our bonus investment, there is one more investment that has the potential to be an inflationary hedge, and that is Bitcoin. Now, I say potential because Bitcoin hasn't had a long enough track record to analyze its performance against an inflationary period, but there are positive indicators, like JP Morgan and Goldman Sachs backing Bitcoin and investing in the future as a whole. But in addition to this, Bitcoin is attractive because it is independent of the US dollar and has a limited supply. However, investors typically look for assets that are less correlated with the stock market during an inflationary period because runaway inflation tends to hurt the stock market's performance. Looking at the 12-year history of Bitcoin, it has become increasingly correlated with stock market performance. This may be a result of its increased adoption, among other factors, but when it comes down to it, Bitcoin is still 5 times more volatile than gold, and currently too correlated with the stock market, especially as of late. Even though positive signs exist, it isn't enough to prove that Bitcoin is a good inflation hedge. So, to sum up, inflation is the decline of purchasing power of a given currency over time. Inflation in 2021 is a concern because of the amount of money the government has printed within the last year. Because of this, we saw the biggest jump in the consumer price index in over 10 years, from just under 2% to over 5%. You can expect to be paying premiums for most things you buy in 2021. We may see an interest hike in the near future to help curb inflation, but this will slow economic growth. There are certain investments that can help protect your portfolio from inflation. The most popular tend to be gold for its store of value, healthcare indexes for their historical performance against inflation, and finally real estate, purchased in strategic locations for increased rents and appreciation. Let me know in the comments below if you would like me to cover any of these investments in more depth. And of course, if you found anything valuable, please drop a like and subscribe if you're interested in learning more about investing. Thank you all for watching, and I'll see you back here for the next video. Bye for now.